Margin calls are generating panic within companies and hedge funds as we remain in a bear market. But what exactly are these margin calls? When do they occur? How do they work? Let's rewind. When the market is green, companies and hedge funds use their crypto assets to apply for loans. For this reason, they leverage themselves in the market to obtain higher returns. These loans are requested in the form of stablecoins or fiat money, while credit is covered with collateral. But what happens when a bearish phase makes an appearance? The price drops and the loan develops a spot in which collaterals are liquidated, leading the applicant to lose all guarantees. Before this happens, the company or hedge fund receives a margin call. This margin call is a notification sent to an investor who is in debt with the aim of injecting more funds into their account. This occurs when the value of an acquired financial asset falls, which prevents the investor from complying with the minimum guarantee deposit imposed by the person or company that has lent the asset. Here's an example. Let's say we need to request a loan of $10,000, and as collateral, we have $4,000 worth of Bitcoin. In order to receive the money, we provide 40% of the total amount as a guarantee deposit. To do so, we turn in our Bitcoin. Now, with the $10,000 loan that we've just received, we invest in an asset. After getting our hands on this, the market experiences a 50% drop, causing our security deposit to be reduced by half, meaning down to $2,000 worth of Bitcoin. What does this mean? That our collateral no longer reaches the 40% guarantee that we signed initially when requesting the loan, and therefore we must hand over an additional $2,000 in Bitcoin to maintain this position. When this situation takes place, the debtor receives a margin call in order to inject more capital into their deposit. But why has this term suddenly gone viral in the crypto world? As the value of Bitcoin and other altcoins plummets, rumors have surfaced regarding potential liquidity problems of some of the most important hedge funds in the crypto field. This is because of several loans that were requested at the time, which now may not possess the required guarantee. Three names stand out. The first is Celsius Network. The cryptocurrency banking and financial services platform has made headlines on countless news platforms, both in the crypto and general fields. Following the suspension of capital withdrawals, many are those that have voiced out their concerns regarding this new structure. The apprehension revolved around the loan requested on MakerDAO protocol. The liquidation ratio was of 145%. However, in the month of June, it raised red flags as the guarantee deposit was of 154%. Over the last few days, Celsius has injected more capital, leaving the ratio at 214% in the hopes of lightening the mood. In addition, a recovery plan proposed by one of its largest investors has cast aside the dark cloud hovering over Celsius. Another name that springs to mind is MicroStrategy. Rumors surrounding a possible margin call have also impacted the company with the largest Bitcoin holding in the world due to the $205 million that its subsidiary MicroStrategy borrowed from Silvergate Capital Bank. Moreover, the company was accused of being unable to even meet the interest on the debt. However, according to its CEO, it seems like this is far from reality. In mid-May, Michael Saylor took to Twitter to warn that a margin call could only occur if the price of Bitcoin fell below $3,562, a value that has been unseen since February 2019. In mid-June, the CEO addressed the rumors once again, defending MicroStrategy. Lastly, concerns around Three Arrows Capital pointed towards a margin call due to its loans on Aave and compound lending protocols. Despite the fact that we're talking about a fund worth billions of dollars, they've had to sell some of their holdings, such as the $40 million worth of Ethers that had been staked on Lido Finance and $31 million on Bitfinex. The pin drop silence on behalf of the company has not helped their case. A cryptic message from one of its founders, Suzu, is the only information that has been provided by the investment hedge fund. Other leading industry voices, such as FTX CEO Sam Bankman-Fried, are confident that this situation could have easily been avoided with a transparent chain protocol. These are just some of the companies and hedge funds that have been caught up in the eye of the storm as they've been battling rumors surrounding their businesses post-market crash. What about you? Do you think other companies will fall victim to this? Will there be more liquidations? Will they receive a margin call? Let us know in the comment section below.